Hey guys, welcome to the Rich Report. Lots to talk about today in the wake of a huge tariff threat, a huge scare. What's going to happen going forward over the next few weeks? We've got a little bit more perspective. There's been a lot of discussion, a lot of thinking about what these tariffs really mean. So we're going to kind of zero in on what's going on here with these tariffs. What does this mean? What does it mean for the Canadian economy? What does it mean for mortgage rates over the next few months? And what does it mean for the housing market? Some of the bigger topics. Take a high level overview of what's happening. And so what it looks like is happening is this 25% tariff threat was really used to recalibrate our thinking about what's to come. It's to change our perspective in that, if a 5% or a 10% tariff is imposed on a smaller part of the economy, on a specific industry or a handful of industries, this isn't going to seem as bad as the existential threat that is a 25% tariff. So a little more digestible. Our perspectives changed on what's really the end of the world. And so the whole world was looking at us and looking at this too and saying, well, are we next for this? And so that's kind of the first phase, if you will, is the psychology of what's about to come. And what it looks like is about to come is the US administration wants to deal one-on-one with every major country. The free trade agreement era that since the 1950s or so was put in place is looks like that world order is changing. All right, so this is a big theme here is the world order is changing from free trade to unilateral agreements or one-on-one between the US and other countries. So more protectionism, less free trade, more one-on-one dealings with the US. So I think Canada and the States and the States and every other country are going to be hashing out a deal over the coming months. It may, come as a 5 or a 10% tariff on a handful of industries. And this, as industry groups and political pressure mounts on both sides of the border, is likely to be changed over months, as we saw during the previous Trump administration. There tends to be longer term or at least medium term changes, but I would expect to see something come up, not a 25% tariff, but smaller tariffs on a handful of industries. That's certainly more likely. And so how does this affect the economy in general in Canada? It's definitely a negative pressure, and we're already seeing this with the uncertainty. Uncertainty is enough to get companies to do feasibility studies. What will it look like to open a factory in the States, to have a more distribution based out of the US? Companies are already leaning in this direction, and certainly companies that may have been looking to invest in a Canadian presence may be holding back on that, pushing pause until there's more stability. So it's already having an impact. Tiff Macklem said this week that he's recognizing that this impact is there, and I think if a tariff is enacted, whether it's 5%, 10%, 15%, obviously the more the worse. This is going to have some degree of effect on the GDP, and we're going to see more of a transition period with a bit slower growth. I don't think it's going to be that end of the world that we were looking at earlier this week, but I do think you're going to have a tougher time already. Kind of a soft economy in Canada, I think, is going to be made tougher by these tariffs. So that's going to have a broader effect, which we'll talk about in just a moment. But there is a silver lining here that I think a lot of people, if they're not excited about it, it's at least something to mitigate this negativity that could happen with tariffs. And that is, it's a wake-up call for Canada to really diversify our economy, to look for other trading partners in addition to the U.S., and to access our resources, develop our resources, and do a better job focusing on investment, how to attract investment from other countries, from corporations, as opposed to, let's just say, a focus on housing, which seems to just dominate or has dominated the news for almost the last 10 years. So, it's a silver lining. It could be a really good silver lining. It could not just mitigate or moderate the effect of tariffs. If we do it right, it could actually turn Canada into a superpower that I think Canada should be. Canada's already a G7 nation, and I think we could become one of the top nations in the world if we use this opportunity and this wake up call. There's some chatter in the media, that Quebec might not be on board. There's a separatist party, the Bloc Québécois, that says, "Oh, this is, having a pipeline run through Quebec isn't in our interest." This is coming from certain interest groups, cultural interest groups are supporting this, and certain industries like in Quebec. But I would take a separatist party at this point with a grain of salt. If we look at the charts, I mean, the Quebec population understands what's at stake here, and they're overwhelmingly in agreement that we should have diversification, including a pipeline, which is something that, even though it's more contentious, they're smart to support, because it is in Quebec's best interest, as it is in the nation's best interest. So, I mean, we could see a big silver lining here. We could see some positive developments along with the negatives. It will be interesting times, but not the kind of doomsday that it looked like just a few days ago. That was, again, more of a psychological reset or tactic, if you will. So moving on to mortgage rates very quickly. I mean, this is likely to put negative pressure on mortgage rates, downward pressure. I don't think we're going to see, 3% or 2.5%. Those days are behind us. When we saw mortgage rates, fixed mortgage rates, variable in the 2% range, this was a coordinated effort, a global effort, whereby almost every major country, and led by the U.S., was lowering rates together. It was synchronized. So Canada was able to do that along with the rest of the world. We didn't really stand out for doing anything overly unique. This time around, the U.S. is not, getting busy lowering rates. They're holding off. They might cut, once or twice this year, maybe 3 times, but they're not looking at cutting a lot. Neither is the rest of the world. So if Canada really, cuts aggressively, we're doing it on our own, and that's not going to be supported very well by the international economic community, the trading community who buys Canadian bonds. In fact, if Canada is in such a bad position that rates need to be, 2.5 or 3% on the mortgage side, it's likely that Canada is in such a dire position that, our risk has gone up. Our debt, our bonds that we sell to raise money for our government, for various projects and social spending, those costs would go up if our debt and our bonds, if the ratings were lowered. All right, there's higher risk, and when those costs go up, well, you need to sell even more debt, even more bonds to pay that higher interest, and so it can really spiral if you're not careful. In fact, another COVID-like spending bout could be the straw that breaks Canada's economic back, in that our debt gets re-rated. So not looking for crazy low rates. If we hit the mid 3% range with some, a bit more downward pressure, I'd say that's definitely a window of opportunity to maybe lock in to a 5-year fixed. But again, I don't think we can structurally see a rate in the low 3% or high 2% range. We're just not in that same economic environment globally to be able to do that. So we're getting closer to a bottom, I think, as rates cut under 4%. Some are slightly above 4% for uninsured, and there are several lenders now offering under 4% for insured mortgages. We might see this creep down a little bit more, but not, it's not going to be ongoing. So this will affect the housing market. Lower rates will certainly incentivize those looking for houses to maybe buy. Now, right now, with all the uncertainty, I think a lot of buyers are holding off. As far as we can see in our firm here, we've got a bit of a sample size with Altrua Financial. We are seeing some buyers holding off. We're also seeing a few, jumping in, and over the last couple of weeks, especially since the last Bank of Canada cut, maybe not in the last week, but before, this last weekend, started to pick up a bit, but this week holding off again now. I expect this to continue for at least a few weeks, and what it looks like is the inventory levels are really skyrocketing in GTA, and according to Treb, to the highest levels seen since 2009. And so this is an unusual amount of inventory to be seeing, and likely what happens when inventory stays high and continues to grow is that some person in a neighborhood needs to sell for economic reasons, or they just, maybe there's a death or they're moving or whatever. And so they'll take that lower price that drives down prices for the rest of the neighborhood. And we could start to see more and more of this, the more inventory that creeps up. So even though, sellers have been very strong in not accepting lower prices, and we actually saw this in January with some price growth in GTA, this could start to break down a bit this month in February as more and more inventory just comes out. It's almost inevitable. You're going to see some negative price pressure, and definitely leaning towards a buyer's market. Are we looking at a crash? No. Given the expectation for maybe some tariffs, but not 25%, there's likely to be some negative pressure there, but not a crash. And in fact, once there's more certainty, even if there are tariffs, once there's more of a firmer ground to stand on and to operate from, not every facet of the economy is going to be ultra affected. Some will be affected more than others. And so you're going to have more people proceed to buy a house. I think we could see, February and March be a little more negative for housing. April, May, things could pick up and firm up a bit. Overall, I'm not seeing any, kind of, again, ultra negative 10% crash. At the same time, I'm not seeing 10% growth. You may see low single digit growth this year, given lower mortgage rates, given those that are holding off on buying decide to pull the trigger in a few weeks. There's more incentives for first-time buyers. There's the 30-year amortization. There's over 1 million for insured mortgages. Not that I encourage more spending, but these are incentives the government has put in place. All taken together is supportive of the housing market. So you could see more of a balanced market and some slight price growth as we progress into the spring, although maybe not in the immediate future. That's everything for this week. Feel free to leave a comment, connect with me at Altrua. I appreciate your watching, and I look forward to our next video. Thank you.